Okay, is my screen visible? Okay. Uh, we start today's market talk. Uh, I find that gentlemen are nowadays preferring bonds. Why I'm saying this is because uh, investors have once again turned overweight on bonds due to central banks' intent to keep the rates higher for longer. Fed was hawkish in its policy, and the tones of Powell were very hawkish, and the bond yields have gone up. So the US 10-year yield is at approximately 4.5. So if the yield is at 4.5, the FIs and the foreign investors start thinking that is it worth the risk to take to invest in equities when the 10-year bonds are giving you 4.5 and all that, or the interest rates are so high in their own countries. Now the other point is the PMI numbers from Europe and UK have shown that the economy is slowing down, but they may cut interest rates, but the Fed is projected to be around 5.6 by end of 2023 and may cut 50 basis point in the whole of 2024. Why? Because GDP is projected to be at 2.1 coming down soon. So economy is strong. The jobless claims are less and all that. So all that theory about recession and all is nowhere. So the interest rates are going to remain higher, and that's why there is a lot of interest in bonds nowadays. Now the other bond in point was that inclusion of Indian bonds in the government bond index of emerging markets by JP Morgan is a very good inclusion and was much awaited for last 2 years or so. This will trigger passive index flows, lower bond yields, lower cost of borrowing for the government and the corporates. It will be positive for the rupee because the rupee will stop depreciating because there is more foreign currency flow which will take place in India. The point to be worried about is the rising offers for sale and promoter selling, which should be a red flag for the market, but because of euphoria, people are just ignoring it. Because uh, should you buy shares of a company whose owners are selling in open market or even in primary market? Lot of new IPOs which are coming are majority is OFSs only, or the major portion of the IPO is OFS. And what we have seen is all this promoter selling and PE selling is roughly 80,000 crore till August in 2023 only, which is double what was there last year. So why would a promoter sell unless he knows that his stock is overvalued? So next issue is the crude, which is reaching around 100 per barrel for shortly. It will reach. It has already hit 95. It should go there because it is because Saudi Arabia and Russia are extending production cuts till December. Shortfall is roughly around 3 million barrels per day, and oil is likely to hit $100 per barrel. Oil India and ONGC remain vulnerable from this to the windfall tax, and OMCs will witness squeeze on their margins. Now, this is I will cover subsequently also when I will cover the Reliance chart. This is probably one of the reasons why the Reliance is correcting. I'll cover when I'll cover the Reliance chart.
Tarun, one point about who are the major promoters who are selling their stakes?
Uh,
Which
see,
which major companies?
sir, as I remember, one was in Indigo,
Indigo.
right?
Okay.
That is there. Then in I think in Timken they sold, right? There are so many. I'll put it in the group because I don't really
Yeah. Okay.
remember.
Fine.
But exactly, I right now it is not coming into my mind.
Okay. Fine.
So a lot of things will depend on crude oil prices and strength of dollar and US bond yields now. And it is not only that the bond yields or the prices of dollar and all. versus the rupee will depend only on the inclusion of Indian bonds in the government bond index. So let's talk about Tata Steel first. There is a lot of euphoria on this, but I would recommend to remain neutral and await further clarity on this. It is because UK has opted to replace its existing 3 million ton blast furnace plant with 3 billion ton electric arc furnace plant. Now, electric arc furnace plant is less costing, more efficient, green, and all those issues. But the projected capex is 1.25 billion pounds, out of which UK government is providing only 500 million pounds. So the balance has to be put in by Tata Steel. Now, Tata Steel has already got a loan of a large amount to the Tata Steel UK branch. So long term, it will be profitable due to lower cost structure and policy support by government by way of carbon border tax and all those things. But this capex will be over 4 years. This plant will come up after 4 years, and Tata Steel UK will have to incur one-time restructuring charges. So there will be a lot of write-offs and all that. Steel prices have already increased, but cost of iron ore and coking coal have also risen, and China has started exporting steel because their economy has slowed. So one has to be careful and not get carried away by just saying that Tata Steel is a good stock. And the stock has corrected also. The other stock is Triveni Engineering. It has a sustainable opportunity in ethanol and power transmission business, but an uncertainty looms over sugar production. The reason is sugar sales have dipped, exports are not allowed because government wants to control the prices in the country. It has a strong order book in engineering division and district, and it is expanding its distillery capacity. So that is positive. But I found that the year on year gross revenue is growing only by 5% in Q1 FY24 and profit after tax by 2%. Distillery revenue grew by 40% and power transmission revenue grew by 78% in Q1. Water revenue was flat, but sugar revenue was down by 15%. So it is balance of all those things, and roughly I think 60% of the revenue is from sugar production. And the stock went up in the last month or so after this treaty in G20 regarding biofuels and all those issues. The company is planning to expand distillery capacity uh, by 2025. I think the government has said that the ethanol production would be around 20, or ethanol mixing would be around 20%. So that is the thing to be looked at. Their power transmission thing is also doing well. They are getting orders. Risk is rise in state advice prices for sugar cane. So what will happen is the sugar prices are not increased, but the government tells the sugar mills to pay higher price to the farmers. So then their margins go down. Last is Ujjivan Small Finance Bank. Uh, it is once you go through its parameters, it's a very good stock. It had a dream run last year. I think it went from around 50 not to 50 rupees due to improvement in asset quality. Uh, it has maximum growth due to microfinance, that is 72%, and NIMs were around 9.25 in Q1 of FY24. That is superb. Put, the provision coverage ratio is at 98%. Bank has grown retail deposit and is confident of maintaining an ROA of at least 3%. Q1 ROA was return on assets for 3.8%. Just for reference, just check the ROA of most of the PSU banks. It is below 1. Some of them are 0.3, zero point 0.4 also. So if the return on asset is 3.8%, see how much should be the profits. And at 1.5 times FY25 expected book, it has lot of value. Even the best of private banks are at 2.5 or 3 times, that is ICICI Bank and Kotak Bank, at that times book value. The only point is that since these guys are lending more to MSMEs and microfinance and all these things, these stocks also become kind of cyclical stocks. Now let's talk about Nifty. If you see, Nifty last week corrected. This is a 1 day chart. It corrected from after making a top to around 20,200, and now it has come below its 20 EMA. In my view, the 50 EMA, even if you see the last time when there was a dip, the 50 EMA provided a kind of a support here. So it should provide support. Otherwise, then it goes down to the last low, which was around 19,200. So that is the levels to be seen. Let's see the Fibonacci retracement part. Now the 61% retracement comes to around 19,600. But in my view, as we saw in the last one, the 50 EMA is coming to around 19,550. So that should provide a decent support. Now let's see the weekly chart of Nifty. You see the weekly candle is pretty big red candle and it's a bearish one. So in my view, again, as per this chart, it seems that the lower channel of support is this, the biggest, the support around in August, which we got at around 19,200. Now this is the option chain of Nifty. So if you see, the maximum call writing is at 19,800. That is 2,11,000 calls, and maximum put writing is at 19,500. That is 1,26,000 puts. So if you see, the premium here is 30, so that means the range should be around 19,450, and premium here is 50, so the range should be 850. So this should be the range for Nifty in this week at least. So all those guys who are looking at, say, selling option strangles can take this Nifty strangle very easily and will make money out of this both ways. Sell maybe 450 put and sell 850 call. So that is easy. Now here if you see the put call ratio for Nifty, it is, the total number of puts are around 18 lakhs, the total number of calls are 22, so the put call ratio is 0.8 approximately. So it is bearish. That means more calls are being written. That means people not expecting the Nifty to go up. Now talking about Bank Nifty or Nifty Bank, see, it has broken through its 50-day exponential moving average, and now it is likely to take support at around 100-day moving average, which is around 44,254. So that should be a reasonable level. Uh, but I would like to see the August lows here for Bank Nifty, because these level of 43,500, 43,600 are the where the support was provided in August. Now the weakest component, as we have seen last week, was HDFC Bank and ICICI Bank both. And in case they remain weak, the Nifty Bank is likely to remain weak. Now here if you see, this is HDFC Bank weekly chart. See, this is the trend line on which it has always taken support. This was the support during COVID times, and then again in June of 22, and now. First time it took support here at 1560, but now it has broken that. So let's see where it goes finally. At 1530 is that what I was thinking of a support. So in case this breaks, then I think it will go below 1500 and somewhere it will settle between 1400 and 1500. Then the results are out, and then results we can take a directional call. PSU banks are looking good, and I think the focus will remain on PSU banks. This is their daily chart. So this is trading well clear of 20 EMA, and it is looking very smart, strong. So they had a dip, but then the news of inclusion in the global bond index again pushed up the stocks on Friday. Again, now the public sector enterprises again chart is looking strong. This is a monthly chart. So if you see, they are looking very strong, and they're heading to higher levels. So one can remain invested in public sector enterprises. And IT, one has to be careful, because in case the results are good, which will start off in first week or second week of October. It will take off from here. But again, if it is bad, then it will break this upper trend line, which is their support. Though they had a negative week now, and there is some kind of correction which is coming in into the Nifty IT. The momentum index is still okay. It is taking support in that inner line of the midline of the pitchfork. So it is not showing any break or any slowdown and all. So the stocks which are in momentum are looking strong. And this is the BSC momentum index. Just see all these stocks. This is on Friday. So roughly half of them were positive and half of them were negative on Friday. And I think most of them are in FNO, and these are the stocks to be played for making any gains and all that. All of them are the ones which are giving good returns. Now, when I was talking about a trend change, this is where the trend change is taking place. If you see after the breakdown last week, last to last week of Midcap index, now it is somewhere taking support at 20 EMA, and one has to be careful. It had has a steady rise from March onwards, and it has always traded above the 20 EMA. But now, if case it breaks, then there would be a big correction which will come up in lot of very popular stocks. Similar is the case with the small cap index. Again, it is this one has broken through its 20 EMA, so it can easily fall another 1,000 points, where then it will get support at 50 EMA. So one has to be careful with these stocks, because as I brought out, this large size of red candle is not a positive sign. It is just not a one day affair, and it tried to bounce from the 20 EMA, but then it has broken down, and now it is trending below that 20 EMA. Now, when I was talking about Reliance, uh, the Reliance, if you see, is heading now towards its 20 EMA, and in case it takes support there at 20 EMA, then I think market will stabilize. Otherwise, the double whammy of Reliance and HDFC Bank is no market can recover from that, with where stocks have roughly 25% weight on the index. Now, the what is the reason for this? In my opinion, it is related to the oil, because Russia has said that they will reduce the production of oil and stop exporting to a lot of countries. And Reliance was making a lot of profits because of refining and selling diesel to the Europe. So their refining margins will be down, and that is one of the main reasons why the stock has corrected. This news is out now only, but I think the smart people were already aware of it, and that is why the stock corrected roughly around 100 rupees in last week only. Now, I'll just cover few momentum stocks. One is RVNL, the daily chart. If you see, it had a rise and then it corrected once it touched near 200. So it was a big favorite stock, but still it is above 20 EMA. So those who are in for a shorter duration should keep a stop loss of 20 EMA, and above that it is good. And now it will move with the orders. So suddenly one day you will have a news on orders and all that, so the stock will start moving. But that trending move is out now. Though it becomes good in case the stock is closer to the moving averages, so that then it is not kind of overbought. The other stock, which was again very popular, was Jupiter Wagons. Now you see it is forming a correction after that day, and it is having a lower trend line, and now it has come to roughly around 303 levels and all that. So one has to be careful with these stocks. Next line of support would be around 50 EMA, but I think uh, this will give up because the base has not been formed. So it had a vertical rise from here, so the base was not formed. And in my view, I think the correct levels of the base should be somewhere around these levels, say roughly around 200, 200 and 180 levels, from where the stock had taken off. And that is the level to get this stock in case you want to have a margin of safety. The other stock, which was again in lot of news and lot of popularity, is Genus Power. It made its stop somewhere around 280 plus, and now again it is correcting. So someday some news comes, it goes up, there is a buying, but the trend is broken. And right now it is above 20 EMA. So if it is supported here, then it's good. Otherwise, it will uh, again correct. So one has to be careful with these stocks. Now the detailed view on three stocks I'll cover. First one is PNC Infratech. This company undertakes infrastructure projects including highways, bridges, flyovers, power transmission lines, and towers, airport runways, industrial area development, and other infrastructure activities. Order book at end of Q1 FY24 includes newly won projects, four hybrid annuity model, it's called HAM, and one engineering procurement and construction, that is EPC road project worth 4,000 odd crores. And total order book is roughly 18,900 crores, that is 2.6 times trailing 12 months revenues. So expect a healthy revenue compounded growth of around 13.5% for next 2 3 years. It is in discussion with potential investors to monetize its assets. I'll explain why it is required. So 11 ham and one bot, that is build, operate, transfer project, that is Bareilly Almora, is under the block to monetize debt of around 6,900 crores and equity of 1,700 crores. Medium term trigger is asset monetization, which would free up capital and drive scalability. EPC companies, including PNC in FY22, witnessed an impact on margins owing to steep rise in raw material prices, and hence these stocks had corrected. And the prices, if you remember, for all cement and steel, everything had gone up, so that impacted their uh, profits and all that. Now, talking about this HAM, that is hybrid annuity model, uh, what happens here is NHI pays 40% of the project uh, expenses, and 60% has to be arranged by the road developer. NHAI pays this 40% in 5 installments as per the completion of the project. So there is no problem of the promoter or the company in arranging for funds. Now, in this 60% which is to be arranged by a road developer, developer finances 20 to 25% in terms of equity of the total project cost and raises remaining as a debt. So, and the other thing which is happening is that the government remains responsible for toll collection. Hence, that risk of adequate revenues from the road is not there, and they get a annual annuity for a fixed amount as an annuity for building and maintaining a road from the government. Hence, all these road construction companies are doing well. Now, the other advantage is earlier, like you have EPC, as you have read it. EPC is when you get a contract and create an asset as per the requirement and take your money. After that, there is nothing. And build, and the other one here is called BOT, that is build, operate, transfer project, where you build a project, operate it, earn revenues, and after 15 or 20 years, whatever has been fixed, you transfer it back to the government. So you get revenues as from the toll and other things which you collect. So the it has been found that HAM is a better option, and more developers are going for this as compared to EPC oblique the bot. And even in bot, they have uh, added a annuity concept because and removed the collection of toll aspect. So the toll is being collected by the government, and the company is not involved in toll collection. Now PHC, if you see, this is their revenue quarterly results. So the revenues are going up. The margins are also good, and EPS is also doing well. If you see, the EPS had dipped in 21 and 22 because of higher input cost, but now it is improving. And if you see the FY23, they did around 7,000 crore, and they are expected to do around 9,000 crore in FY25. This year they expected to do around 8,000 crore, and EPS is expected to be around 30 odd for FY25. So if you take a EPS of around 30, and give it a valuation of 15 times PE, it should easily trade at around 450 rupees. Presently, it is at 370 rupees. So this is the other calculation, projected calculation for EPS and all that. So if you see their ROEs and ROC and return ratios are improving. Operating ratios are also improved. They don't have much of debt on their books, and whatever debt they will take will remove in case they are able to sell these projects. So what they are trying to do is they are planning to sell this thing to KKR. They are in talks to acquire assets for around 9,000 crore. So sell these projects to them, and then they have more money, so they can bid for more HAM projects. And since they are required to put their own equity, they will have money. 20-25% they have to put their equity in that. So for that they require money. CAGR for revenue is expected to be around 30%, was around 30% in the last 5 years, and is expected to be good 13 to 15% next 2 years. Return ratios are, as you have seen, are 20% plus. You see here ROC and ROC, so which will drive the profits. If you see, this is the chart, right? So in 20, the where the prices of inputs were higher, the stock had dipped, but now it has risen, and now it is trading well above the 20 EMA. But the level to enter it should be around, because of the cyclical nature and news-based issues, should be around these levels, 345, 354. That should be the level to enter these stocks. So as to have some margin of safety. The next one, which I'm going to cover, is Cummins. It designs, manufactures, distributes, and services diesel and alternative fuel engines from 2.8 to 9 liters, diesel and alternative fueled power generator sets of up to 3000 kilowatt hours, that is 3750 kVA, as well as related components and technology. It has guided for double-digit sales growth in FY24, expecting top line to grow at two times GDP growth for next 8 to 10 years. So that should be giving it around 15 odd percent growth in for next 8 to 10 years. Maintaining guidance of 100 basis points improvement in margins, given sharp focus on cost management. Demand scenario continues to remain strong for domestic power generation market, with continued sales of CPCB2 and CPCB4 variant products in geographies like NCR. Now, CPCB is Central Pollution Control Board. Just for your information, the latest norms which are supposed to be implemented for next year are CPCB4, which are likely to be cutting the emission norms for power generation engines of output up to 80 kilowatt hours. So what will happen is, if once the pollution norms become stricter, hence the ones who are able to make such kind of variant products which are compliant with the pollution norms, they would be in demand. Now, there is a lot of demand which is seen in sectors such as data centers, infrastructure, commercial and residential real estate, and railways. The imported components of CPCB4 variant products will be localized, and accordingly, it will help in improving the product margins. So, if you see their revenue stream, the revenues are growing up every quarter. The margins are roughly around 15 to 17%. The profits are also going up because certain quarters they have higher profits. Generally, in the December they have higher profits. If you see, they are projected to have this is in millions, so roughly 9,720 odd crores of sales in FY25 is expected, and a EPS of roughly around, again I said 50. So if you give it a EPS of 50 in FY25 and a PE of around 35, so at 1750, I think it is fully priced right now. So it has to be correcting adequately for it to be able to give some margin of safety. All parameters are improving. There is a lot of demand for generators and all that, and it's a dividend giving company, so everything is good. It has a good parent, which is an MNC. So this stock is a good stock to hold for long term. If you see the key financial metrics, return ratios have improved and now roughly 20% plus. The debt is negative, there is no debt, and working capital days have generally been stable or improved to around 60 plus. So the P is this year P is around 42, so it expected to come down as per the present valuation. EV/EBITDA is going down. Price to book is roughly around 8, and the dividend yield is good as improving. So all parameters are good for this stock. So if you see the chart of Cummins India, it corrected here, say roughly around, it had reached around 2000 levels. Then on the news that they had to give some royalty to their parent, they corrected, and now it is in a range sideways for last so many days, and now it has come below most of its averages. So it will be a decent buy if it comes closer to its 200 EMA for long term. The last stock which I'm going to cover today is Interglobe Aviation. Now, it's a largest passenger airline operating as a low-cost carrier in India. The concerns are higher ATF prices and lower passenger load factor points towards likelihood of an overall weaker spread in Q2 FY24. So it is expected that this quarter is likely to be weak. Its market share has stood at 63.4% and has improved 20 basis points month on month. And the complete Tata Group's combined market share is roughly 26.8% in August 23. So it is a clear market leader, and recently with the Go Air's operation also not taking on, the Indigo should benefit from there. The passenger load factor for Indigo remained muted for the second month in a row at 83.6%. So that was the reason why the stock performance is also not good. Uh, Regarding that Pratt and Whitney engine issue, I think they would explore secondary markets and take aircrafts on wet lease oblique dry lease in the wake of increased grounding, which will happen from in future in next 1 or 2 years of for their engines. Seeing their quarterly results, if you see the revenues are constantly improving and operating margins are improving because of higher revenues, and operating profits have improved, and suddenly it became net profitable. So all the losses have been taken care of, and last quarter was very good, and EPS was around 80 rupees. So if you see, this is the one which shows the monthly market share movement percentage. So if you see here, Indigo has improved its market share, and now it has reached around 63.3% in August 23, and this is the state of others. And with Go Air gone, SpiceJet in trouble, losing market share, Air India again, it is going down. So it's a clear market leader, and because of efficiency, it is going to gain. Now, if you see the daily passenger broadly have been daily passengers which they are carrying, they have been broadly around 40,000 or this thing is there. So it is 400,000 means it are there. So this is the chart. So they have maintained this level of passengers daily. Now let's see the chart. It took off after the results in the second quarter, and now it has corrected because of all these issues. Below the 50 EMA and all of 2440 and all, it has corrected sharply on Friday. So the 200 EMA of roughly 2270 would be a good level to buy this stock for a long term. I have finished. We'll take questions now.